Thursday, April 2nd, 2020, MONERO 64, home of alternative economics and contrarian views. This morning, I want to talk about how the key to holding gold is patience. I get a lot of comments from my viewers who are frustrated with the price move in gold. And one of them asked me the other day, how long is it going to take for gold to be valued fairly, so to speak? And I said that you need to have patience. I've been waiting since 2002. So that's what I want to talk about. Also a little bit about the psychological warfare that goes on from the mainstream media, from academia, from economic sphere against those who hold gold. They're denigrated, of course. They're called gold bugs and kooks and conspiracy theorists. There was an article the other day on the Wall Street Journal last Friday about how gold was in short supply, and they called people who hold gold conspiracy theorists, right? So I want to go over that as well. And then when I finish looking at gold, I want to look at the markets as usual and at some charts. So yeah, patience. There is a saying that patience is a virtue, right? Believe me, I've been known not to be patient, but sometimes you need to adapt and try to be as patient as possible. I guess golf kind of has taught me to be patient. Golf is a great game. It's kind of like life. You get bad breaks and good breaks, but you need to keep going. I'm not going to go too much into golf, but just wanted to say that. So I'm going to start with the psychological warfare. And even though I do subscribe to the FT, I have been subscribing to the FT for just over a year or so, I think. And why do I do that? Well, because they still get some of the fresh information and stories about the markets. But their philosophy, as I said recently, the way they think is not to my liking. They're globalists. They're not really trying to help the general public, in my opinion, with their investments. They have an agenda, and it's I think one needs to look at who sponsors them, who are their biggest source of advertisement revenue, and that's of course Wall Street, City of London. So you get my gist. But I've spoken about this story quite a few times in my videos over the years, but I'm gonna go over it again because I get a lot of new viewers and subscribers every day, and I think this story will show what I mean by patience. Yeah, having patience when holding precious metals. So this was 2004, April 16th. I even remember the day. Why do I remember the day? Well, because I cut this editorial from the FT that I was reading on the platform on the way to work into the city. And I used to take the train around 6 a.m. in the morning to be in the office by 7, because that's the time the markets open here in London. And I used to buy the FT. Used to turn a lot to the editorial page. For some reason, I like to read the editorials first. And I was on the platform, and I saw this story here. Going gold, as you can see. So I'm going to read over it. And this just shows you how the mainstream financial press and academia are totally against gold. And why is that? Because gold is a threat to the fiat currency central banking system. The public having a lot of gold and silver, for that matter, is a threat to the globalists, because they know that you need to control the money supply, and you need to have the gold. And they do have gold. The central banks hold over 30,000 tons. The very, very wealthy hold a lot of gold. They know what gold is, but they don't want you or me to have any gold, or else we don't keep playing their fiat currency debt game. So just to give you an idea, I even wrote, because I cut the editorial, right? And I wrote FT article April 16th, 2004, and I even put the price of gold, $400.65. I think in pounds it was around $222. So it just goes to show you we're over £1,000 higher and over $1,000 higher since then. But let's go through what the FT said. And why did I cut off this editorial? Because at the time already I'd been buying a little bit of gold. I've been reading a lot about the history of the monetary system, and I knew that things were not going to get better, and they haven't. And I was kind of shocked to see the FT writing something like that. But then I realized, well, they're part of the game. They don't want you or me or anyone else to get involved. So it says, the pointlessness of holding bullion continues to sink in. So let's go through this editorial. It's going to take a little while, but I think it's important. You can pause the video as well and read it, or screen shoot the editorial so you can read it later. The barbarous relic, as Keynes called it, is crumbling to dust. Well, Keynes said the gold standard was a barbarous relic, not gold, but anyway. When even the venerable N.M. Rothschild has quit the gold market, and the Bank of France, among the most stubborn of the official gold bugs, is thinking again about its bullion holdings, the end of gold as an investment has come a little closer. Well, what happened to N.M. Rothschild? They just stopped being involved in the bullion dealing business, but I'm sure they still have quite a bit of gold. It will not be before time. The fetishization of shiny yellow metal decades after it ceased to be used as the anchor of the international monetary system is a lingering anomaly in modern financial markets. Perhaps Rothschild's last service to the bullion market could be to keep a live gold trader on display behind the glass as a reminder of a bygone age, like the former coal miners who now make a living giving tours of defunct pits. They even have a dig at the coal miners, the FT. The one advantage of gold as a reserve asset is that, unlike assets based on fiat money, governments cannot make it worthless. That's right, by inflating it away. But in an era of low inflation, and given that independent inflation targeting central banks are the norm across the industrialized world, that risk has very sharply diminished. Little did they know, they consider inflation their phony measure, CPIs, but we know that inflation is the creation of money and credit, and we've had that in spades since then, and it's exploding, as you know, right now. Indeed, for both private and official investors, gold is now a rather risky asset with a nil or low return. The intrinsic value of gold, determined by its use in various industrial processes, is well below its market price. Gold does not grow, so its value to any investor as an asset is dependent on other investors also holding it as an investment asset. The gold price hangs precariously by its own bootstraps. So yeah, gold doesn't do anything because it's money. That's what money's supposed to do. And a lot of people argue that gold doesn't pay any interest. It does for the very wealthy, even though right now it looks like they're not making decent lease rates. They're not making a lease rate at all, so you can lend gold, take the proceeds, and lend the proceeds in the interbank market, but the lease rate now is negative. But so are interest rates now. They're negative. So if you hold treasuries or bonds or any kind of government paper, you might be getting a small return, or even you're not getting a return at all because you're getting negative interest rates. For private investors to hold gold on this basis is their own foolish affair. So I'm glad at the time I was ready, well versed enough in the history of money and what gold was. Because if I wasn't, I would have been worried about this and might have sold my gold. And I think maybe a lot of people did after they read this, or were discouraged from getting any gold, and stayed in the FTSE or and in paper assets, and they might have seen a bit of growth in their portfolio, but it would have been a lot better if they had some gold, I would say. For central banks and governments to hold it as a reserve asset is a betrayal of the public on whose behalf they're acting. Despite recent sell-offs, governments and central banks still hold about a fifth of the world's bullion. I told you, they still know the central banks and the big boys and the elite, they know that gold is money, so they hold it. They don't hold cash. They hold just enough cash so they can do what they need to do day to day, so to speak. Their large holdings relative to the size of the market by themselves make gold particularly ineffective as a reserve asset. The very act of official selling of bullion on any large scale to raise cash will itself drive down the price. This danger was amply demonstrated by the UK's unhappy experience of trying to sell some of its gold holdings. Announced in 1999 in a sensibly open and transparent fashion, the sales sparked such a fall in the global bullion price that a group of central banks signed a concord limiting such sales. That has recently been superseded by a new agreement providing for limited official sales. While that was the Gordon Brown bottom, and it wasn't sensibly done, it wasn't sensibly planned. Gordon Brown pre-announced the sale months before he was going to do it. So what are people going to do? The speculators, they're going to sell ahead of that, and that's why gold went down. He should have announced it after the fact. They should have done it on the quiet. But the reason they did it, in my opinion, and a lot of people speculate about this, is that there was a big bullion bank that was in trouble at the time. And in trouble, usually bullion banks, it means that they're short and they can't get the gold. So that's why that was announced. The price went down and they short covered. So let's finish off. Given the pointlessness of holding gold, the speed of its official sell-off scarcely matters unless leaching the gold into the market bit by bit somehow maximizes the return to the public purse by limiting the impact on the price. That would imply some irrationality on the part of the market, but then holding gold is irrational in the first place. Perhaps the central banks are right to go slowly. Whatever the speed, the direction is clear. Gold is on its way out as an investment and a reserve asset. 3 cheers for that. So, yeah, someone reading this who doesn't know much about gold, he or she will be totally discouraged from having gold. People who have gold and are not too sure about having gold, they're going to be spooked. Maybe get rid of the gold or not get any more gold. And that's the kind of service and advice the FT gives you. And in the last few weeks, they've started covering this crisis, and they say, we're the voice of reason. Read the FT to know all about, I'm not going to say the name, right? You probably know what I'm talking about. So that's what the FT is about. It's about misinformation, in my opinion. And this is proof of it. So how can you learn a little bit more if you're just getting involved in precious metals, gold and silver? I've got a couple of books that I think will help you. And right now, a lot of us have a lot of time if we are at home on lockdown. So maybe you can read a little bit more. One that I recommend is Gold Wars, The Battle Against Sound Money as Seen from a Swiss Perspective by Ferdinand Lips. This is a great book. Ferdinand Lips, I think he died about 10 years ago, maybe a little more. He was a banker from Switzerland. He even worked for the Rothschilds, but he exposes what this battle is all about against sound money. Highly recommend it. And the other one is more about money itself and what has government done to our money and the case for a 100% gold dollar. And that's from the Austrian school economist Murray Rothbard. Highly recommend those two books. So yes, patience is very important when you're holding gold and silver. Gold and silver, like Oliver Temple said in an interview with me a few days ago, is not for making a quick buck. It's for security and safety of your assets, of your wealth. And as Jim Rickards said in an interview with me a few weeks ago, you need to think of gold and silver, not in terms of fiat price, but in terms of the weight, the ounces, the grams, the tons for some of you. What do I do in this channel? Do I tell people to buy gold? No, I just talk about it. I talk about my experiences. I try to inform people about what gold really is, what the powers that be think about gold. And a lot of you have asked me in the past, how can I get gold? So I provide a promo code for a bullion dealer, goldinvestments.co.uk. It's MONERO64. If you use that, you get a small discount when you're buying some gold or silver. And the details are below in the description. And I also provide a referral or promo code for GlintPay. GlintPay provides you with a prepaid debit or credit card. Well, it's a debit card. And they store your gold in Switzerland. So you don't hold it physically, but they hold it for you in your name, in an allocated account, in a vault in Switzerland. So I've got a promo code there as well, and it's in the description. Promo code is MarioGlint79, and they have an app that you can use. But some of you might prefer Glint, some of you might prefer physical. So those are the two options I give. And I always tell people as well, don't go for gold investments or Glint if you can find better alternatives. Do your homework. That's all I have to say about that. So let's look at the markets then. This is going to be a little longer, this video, but with so many people at home, maybe you've got a little more time to listen to my videos. So yesterday, another down day for stocks. The Dow was down almost 1,000 points, 4.4%. S&P and NASDAQ as well. The small caps were down almost 6%. So I just wanted to show you a chart of the S&P. And before I show you the chart, I wanted to show you fractal patterns. So there are fractal patterns in nature, as you can see. The pattern, it means that things happen again, kind of in different sizes. I'm not going to go through fractals. If you want to find out a little more about it, maybe you can Google it and have a look. And there's also fractal patterns in markets. You get like patterns that repeat themselves. That's what it is. Patterns that repeat themselves. They're not necessarily the same size, but they look very similar. So I'm seeing a very interesting fractal pattern here in the S&P 500 index. You can see there the first shaded oval or circle and the second one, they look very similar, and the second one is bigger. So what I'm trying to say here is that I think we're going to have another leg down, and it's going to be much bigger than the leg down we had after that first consolidation. So that's how I see the stock market at the moment. It's 8:07 a.m. Let's have a look at the markets then this morning. We've got spot gold, 1594, up about $4 or 1/4%. The low's been 1580 and the high 1598.80. That's spot gold. Silver is up 25 cents, 1.8%. So silver is doing well relative to gold. It's at 1420. The Dow is up 290 points. The Dow future up 1.3%, 21,200. S&P is at 2,500, up 31, 1.3% as well. NASDAQ 100 is up just over 1%. The currencies, sterling or cable is up slightly, 1/3%, 124.12. The euro is down 0.2% at 109.40, and the dollar is up 1/8% versus the yen, Japanese yen, at 107.28. WTI crude is up 8% actually, almost $2 at 23.56. The 10-year yield down 4 basis points at 0.59. So still not doing great. And that's why I think the stock market is going to do what I told you as per that chart. Anything else? Yeah, just one more thing. We have jobless claims today. Jobless claims is usually not that important. It comes out weekly. The most important number, of course, for the U.S., for the markets, is usually the job data, the non-farm payroll that comes first Friday of the month. I think it'll probably be out tomorrow. Sometimes when the Friday is too close to the beginning of the month, it's a week later, but I think it's tomorrow. But anyway, jobless claims comes out weekly, as I said, and it accounts for the people during that week that claimed for unemployment insurance, so initial jobless claims. Last week it came out at 3,283,000. Why is that significant? Well, because that's like increased by a factor of 10 of what it usually is. Usually it's around low 200,000s to high 300s. Sometimes in times of recessions, it gets up to 500,000, but 3.3 million almost. So it's going to be important today. Again, this number, they expect it 3.5 million. I read something recently, though, saying that the systems were so clogged up because so many people are trying to claim for this insurance that a lot of people didn't succeed in claiming. Maybe even 1 million people weren't able to do it. So we might even get more than 3.5 million. Who knows? So that's going to be important for the markets, I think. And of course, jobless claims comes out at 8:30 a.m. Eastern Time or 1:30 p.m. London time. If you enjoyed this video, please hit the like button, share it far and wide. Think about subscribing to my channel, and you can also follow me on Twitter, Facebook, BitChute, Steemit, and DTube. I wish you all a great day. Take care. Bye.